What is the first thing that pops into your mind when you think of fraud? Probably not the government. We've been hearing all sorts of conspiracy theories ever since the COVID outbreak, but this one is serious and the evidence very convincing. And what is it this time? Everything you can think of: an impending world war, insider trading, state-level manipulation, multi-year inflationary crisis, and the government is responsible for all of this, says Michael Burry. For those who don't know him, Michael Burry is well known for predicting the US subprime mortgage crisis or the housing market bubble that occurred between 2007 and 2010, way before it happened. And his hedge fund also made a killing in the downturn. His prediction became so eminent that they even made a whole movie about it, The Big Short. Since then, Burry has been sharing his predictions through various platforms, especially Twitter, and he is quite consistent when it comes to raising alarms for impending financial recessions and crashes, two of which he successfully predicted. In recent months, his tweets are predicting yet another drastic downfall. Recently, he slammed the Federal Reserve for lying and not shrinking its balance sheet enough. So, what to expect from Michael Burry's predictions? Stay till the end to find out exactly why Burry thinks the world is moving towards an economic meltdown. Hedge fund manager Michael Burry, famed for forecasting the 2008 financial crisis, criticized the pace of the Federal Reserve's struggle to sell off its enormous pandemic-era balance sheet, comparing the central bank's affinity for economic stimulus to drug addiction. He called out the Federal Reserve for not shrinking its balance sheet as much as had been planned. And this is nothing super secretive, it's public information. It's all happening before our eyes. By the way, are you enjoying this video? Then give it a like and hit the subscribe button. It really helps me grow the channel and bring you the best content about investing. Fed officials have outlined plans to progressively clear the bank's $9 trillion balance sheet as part of a procedure called quantitative monetary tightening, or simply QT. However, Burry noticed that the central bank was falling short of its own goals, citing a recent statement from the Federal Reserve Bank of New York. He tweeted, "Drugs are hard to kick. Fed was supposed to sell $30 billion treasuries and $17.5 billion mortgage-backed securities per month starting June 1. QT, Burry said in a now-deleted tweet. During June, MBS holdings rose almost $3 billion. Treasury holdings fell less than $10 billion. The Fed revealed in May that it would start selling off bond holdings combined as it intended to hold up the US economy throughout the COVID-19 pandemic. As Burry said, Fed officials designated they would sell a maximum of $30 billion in Treasury securities for the first 3 months of their plan, and then shift to a cap of $60 billion per month. The banks also specified it would sell as much as $17.5 billion per month in agency debt and mortgage-backed securities before moving to a $35 billion per month regimen. Fed representatives did not instantly return a request for comment on Burry's remarks, and Burry normally deletes his tweets shortly after posting them. In another post, he said, "Serial half-point hikes are for getting elevation before stocks and the consumer tap-out. Same with rapid-fire QT. The Fed's all about reloading the monetary bazooka, so it can ride to the rescue and rescue the fiscal put." In addition to this, Burry has also stepped up his warnings regarding the state of the US economy. He predicted that markets were likely only halfway through a devastating downturn. Burry foretold earlier this year that inflation would squeeze shoppers and erode consumer spending, while overstocked retailers would be required to slash prices to dispose of additional inventory, eating into commercial profits and choking economic growth in the coming months. And Walmart has just confirmed the investor's position on the matter. The mega retailer protested that high food and fuel prices are borrowing claims for general merchandise in the stores. It has marked down unsold goods and anticipates a sharp decline in profits this year as a result. Michael Burry is right to express his concern here, since it's obvious that some significant economic indicators may suggest an impending consumer recession. Talking to Twitter, he quantitatively expressed how bad things were getting. Adjusted for inflation, 2022 first half S&P 500 down 25 to 26%, and Nasdaq down 34 to 35%, Bitcoin down 64 to 65%. That was multiple compression. Next up is earnings compression, so maybe halfway there. The US economic landscape remains far from picturesque, with a housing market recession, inflation spikes, and consumer price upsurges darkening the landscape. Economists, investors, and even brokers are saying that America is headed for, or may already be in a recession. Despite early signs of recovery and positive forecasts in 2021, and a deceptive resolve to focus on the promising facets of the country's financial health, the administration is now perceiving warning flashes of further and extended pain. However, some are suggesting that rather than a more critical viewpoint, the White House is instead shifting the goalposts in its economic investigation. A recession is often described described as 2 consecutive quarters of economic contraction or simply declining real GDP. The US's GDP fell 1.6% on an annualized base in the first quarter of 2022 and was tracked by a 0.9% drop in the second quarter. Surprisingly, it fits perfectly with Michael Burry's story that we could be facing a drastic consumer recession by the end of this year or early next year. In response, the White House published a blog post titled "How Do Economists Determine Whether the Economy is in a Recession?" The post, in short, defied the idea, continued that a recession is defined by 2 consecutive fiscal quarters of a dwindling economy. The blog post said, instead, both official determinations of recessions and economists' valuation of economic activity are based on a general look at the data, including the labor market, consumer and business spending, industrial manufacture, and incomes. Dr. Michael Burry has also referenced to this with his thesis on supply chain. Precisely how supply chains can experience bullwhip effects. In case you didn't know, the bullwhip effect is when small fluctuations in demand at the retail level pile up and lead to much larger fluctuations in demand at the bigger levels. Wholesale, distributor, manufacturer, and raw material supply levels. For instance, a retailer assumes that the demand for canned tuna is increasing and purchases 2,000 cans. Seeing this increased purchase, the supplier may also increase the amount of tuna they stock. Now let's say that the retailer's prediction turns out to be untrue. This will further amplify the issue. But people are not buying the government's take on the matter. Most agree with Dr. Burry's approach to the situation. Burry flagged inflation as early as April 2020, when the COVID-19 pandemic was still in its initial phases, and warned that the situation could rival America's inflationary disaster in the 1970s. His prediction has proved right numerous times, as inflation gauges in the last 2 years have constantly hit decade highs. Burry fired back at the government with his Twitter account. The silliness is back. After 1929, after 1968, after 2000, and after 2008, the strain of silliness that transformed bulls into bubbles completely and utterly disappeared. But that familiar COVID-era silliness is not dead yet. Like 2001 before Enron, before 9/11, before WorldCom. Not trying to be an alarmist here, but we all know that we're passing through tough times. The only problem is that most of us don't realize just how tough things actually are. Burry claims that he has already done the math and concluded that a global financial meltdown that will lead to World War III is on the horizon and that we are marching towards it at an ever-increasing pace. He shared a negative outlook, signifying that a possibly extended Ukraine war and continual supply chain disturbances would all lead to raising the lower bound of the long-term inflation rate. Burry also said that the continued supply chain snarls and intensifying tensions associated with China's aggression towards Taiwan and the unending Russia-Ukraine war would collaborate to keep prices raised for the foreseeable future. He also shared his view, detailing an onshoring trend in which US companies have progressively shifted manufacturing stateside as they seek to evade the disturbances that occurred during the COVID-19 lockdown. The report noted that construction of manufacturing plants within the US has surged 116% over the last year. Burry said that he expected blue-collar workers to work in short supply, even as office workers face mounting layoffs due to a looming recession. He did not detail his remarks about the geopolitical landscape. The US and its associates have frequently warned China against intimidating Taiwan's sovereignty. Economists have warned that contentment by the Federal Reserve and persistently high inflation could put the US economy back in the grip of recession, which it was battling even before the conflict. Therefore, he is almost certain that World War III is on the horizon. But then again, aren't all alarmists convinced that the end of the world is near? And this has been the case for centuries. Not to discredit Michael Burry's expertise, but this one time I sincerely hope that he's not proven right. Anyways, these were the predictions and warnings that Michael Burry has made so far, and rest assured, more will come soon. This guy does not stop. What do you think about the matter? Do share your thoughts in the comment section below. If you enjoyed this video, make sure to watch our previous video about Burry's predictions. And don't forget to click that subscribe button. I make videos like this every week where I uncover the secrets of money and business. Stay tuned for the next upload.